Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from Philadelphia at the Nasdaq and Villanova University Business School ETF Synapse. Joining me this segment, we have Sean Clark. He's the Chief Investment Officer over at Clark Capital. Great to have you as always. We'll go from the Felix trading floor. Now we're doing conference room conversations.
This is great.
This is really good for you. So it's interesting. Typically, we'll talk about more market-moving events, but this Synapse is focusing on research collaboration, academia. The panel that you just came from, what were some of the highlights that you spoke about?
Well, the panel I was on was really interesting because there were a lot of very smart individuals on there, from SEC regulators to attorneys to researchers, and I was the one practitioner on the panel. And a lot of the conversations surrounded the ETF rule that's proposed to come out, and some of the highlights that the panel discussed were like how that rule is going to impact trading in ETFs, in particular with the proposed custom basket, allowing ETF providers and APs and market makers to deliver custom baskets in exchange for the ETF, which one of the researchers on the panel suggested, and they've done research that showed that ETFs with stricter baskets tend to have wider bid-ask spreads than those that allow for custom baskets. So I think it will enhance the ultimate experience of the end user and really make more efficient the trading experience of investors, asset managers, and the like as they're using ETFs.
So it sounds like they're trying to level the playing field a bit.
Absolutely.
Because the explosive growth of ETFs, the regulators are going to take notice. And of course, they want to come back to leveling the playing field for the investor.
Yeah, and I think a good argument can be made that it's question, are there too many ETFs out there? Right? There's between 1,900 and 2,000 ETFs. Right now, there's about 2,800 companies that trade on the New York Stock Exchange. Mutual funds, there are 7,000 mutual funds. When you consider each of those mutual funds share classes, you can multiply that by a factor of 3.5, almost 28,000 or so different mutual funds. I do think ETFs have gone from a vehicle that was innovative at first to now it's a little bit more prolific. And there's so many choices out there that I, for one, as an asset management firm, running an asset management investment team, we're able to sift through all those different choices through detailed research and our approach and process to how we construct and build really good portfolios to help clients meet their goals and objectives for their assets. I worry that there's too many choices out there for individual investors to make good decisions in structuring their portfolio. There's something out there called Hicks Law. Hicks Law suggests that with too many choices, it takes too long to make a decision, and then ultimately that decision is not geared towards the outcome that the individual is looking for. So it's hotly debated in the industry right now. Are there too many? I think the market will figure it out and sift through all those that don't have assets, and I think there'll be consolidation, and some of those ETFs will likely go away.
It's like Darwinism of the ETF industry. I know what you're talking about with Hicks Law. Going to the nail salon, there's like 300 colors. You're just like, oh my God, it's the hardest part of the process. But let's go back and talk about your clients and how you've been managing their expectations through the midterms. Is it kind of like, thank God that's over with now? Or
Great. Yes. Yeah. So we've been out really loud and often throughout this year saying that, you know what, it's a midterm year, and typically midterm election years tend to have some pattern to them. And going back all the way back to 1934, we've done the research, we looked at it. Every midterm election has a correction in it. The average correction from where the market peaks, whether it's the midterm year or the year before, to the low that it makes in the midterm year, the average decline for the S&P is 21%. We've had now approximately 10% corrections. So we fully expected, and we're telling our clients and advisors who refer business to us, hey, listen, we're going to see some volatility ahead of the midterms. Use it as more of a buying opportunity than something to chase you off and scare your clients away. So we do expect on the backside of any midterm election year correction historically, the market has, by the S&P, has advanced by a 47% clip to the high the very next year. Now, that's pretty extreme. We don't expect that to happen right now, but we do expect, given the economic fundamentals still remain strong, the economy's growing, earnings are growing, growth rates of earnings are likely peaking, but still the fundamental backdrop of the market and economy is strong, so we would expect those normal midterm election year trends to carry the market through. Interestingly enough, the 3/4 of the 16-quarter or 4-year presidential election cycle that are the strongest, 4th quarter of the midterm year, in the first half, so first quarter and second quarter of the next year. The market on average has advanced about 20% over time over those 3 quarters.
Well, it's great.
We're in the sweet spot right now.
So, and if you're a long-term investor, markets are supposed to go up and down, right? That's why we have averages.
Yes.
This thing where it goes from the bottom left of the chart to the top right, like it has over the past 10 years. That's not normal.
You know what's interesting though? Like everybody says 2 certainties in life, death and taxes, right? I would add 2 more: bear markets and recessions.
Right.
The markets are cyclical. They always have been. They always will be. So use opportunities like we've just been through as opportunities to replant those seeds that you may have taken out of the market earlier. Any cash, it might make sense to deploy some of that cash.
Especially if the fundamental backdrop is so strong, like you were saying. It's a great opportunity.
Yeah, and PE ratios, if you look at a forward multiple on the S&P 500, it got down to where it was before Brexit. It got relatively cheap, given that we've had the correction and earnings growth has remained solid. Valuations became a little bit more palatable, and investor sentiment turned sour. And that generally is a time when you want to tweak your allocation and get a little bit more aggressive.
Which is so crazy because in the beginning of October, when valuations were so much higher, everybody loved the market.
Everybody was
it
happy.
sells off, and it's like, okay, there's your normal valuation, and now you don't like the market.
Yeah.
So, all right. Well, thank you so much, Sean, as always, for joining me, and thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter.